There's a specific moment when your relationship with your bank fundamentally changes. Not when you open your first account, not when you get approved for a credit card. The moment happens when you check your balance and the number starts with a 2 followed by 4 more digits. $20,000. Most people never experience this moment. Right now, 65% of Americans live paycheck to paycheck. They're doing mental math at the grocery store. They're checking their account balance 3 times before the rent payment clears. They're one unexpected bill away from crisis mode. But here's what nobody tells you about that $20,000 threshold. It's not just a number. It's the exact point where you stop being profitable for your bank. And when that happens, your entire financial life shifts. The stress drops, the options multiply, the desperation ends. Today, I'm breaking down why banks absolutely hate when you cross this line. Because once you understand what $20,000 actually does to your financial position, you'll see why the entire banking system is designed to keep you below it. Let's get into it. Most people think about savings in terms of months of expenses. 3 months, 6 months, maybe a year if you're really conservative. Financial advisors love throwing around these time frames. You need 6 months of emergency funds, they'll say. And sure, that's technically correct. But here's what they don't tell you. There's a specific dollar amount where the entire game changes. Not percentages, not months, not ratios. A hard number. And that number is $20,000. Why $20,000 specifically? Because the average American household spends about $6,545 per month on everything. Housing, transportation, food, insurance, the works. That's $78,540 per year. So $20,000 represents roughly 3 months of total expenses for the average household. For most individuals living alone who spend around $4,300 per month, $20,000 is about 4.5 months of runway. But here's the thing most people miss. This isn't about having an emergency fund that covers X months. It's about crossing a profitability threshold that your bank desperately wants you to stay below. Let me explain how banks actually make their money. In 2024, the 10 largest banks and credit unions collected $3.5 billion just from overdraft fees. Billion with a B. That's money extracted from people who didn't have enough cash in their accounts to cover a payment. One transaction goes through when your balance is $5 too low and you're hit with a $27 fee on average. Some banks still charge $35. Think about that economics for a second. You're literally paying $35 for the privilege of being broke. And if multiple payments try to clear while you're negative, multiple fees. I've seen people get crushed with over $100 in overdraft charges in a single day. But when you have $20,000 sitting in savings, you never overdraft, ever. That buffer means you always have coverage. The bank makes exactly $0 from overdraft fees on your account. They hate that. And overdraft fees are just the beginning. Here's what really happens when you're living below the $20,000 line. You need money fast for an emergency. Your options are terrible. Payday loans charging 400% APR, personal loans with rates north of 25%, credit cards with 22% interest that you'll carry for months or years. Banks and lenders love desperate people because desperate people pay premium prices for money. They don't shop around, they don't negotiate, they just need cash now and they'll pay whatever it costs. But when you have $20,000, you're never desperate. Car breaks down and needs $2,000 in repairs, you transfer it from savings. No loan, no interest, no fees, no profit for anyone. Medical bill for $1,500? Handled. Job loss? You've got 3 to 4 months to find something new without panic. Most people think savings is about security, and sure, that's part of it. But what savings really does is eliminate the bank's ability to profit from your stress. Every dollar you add to that account is a dollar they can't extract from you through fees, interest, and desperation products. That's the real reason they want you below $20,000. Not because you can't handle money, but because you stop being profitable the moment you cross that line. Let me walk you through exactly how much money banks extract from people who don't have that $20,000 buffer. Start with overdraft fees. Banks made $12.1 billion from overdraft and NSF fees in 2024. That's up from previous estimates because it turns out credit unions were hitting people even harder than big banks. The data shows that 9% of accounts pay 79% of all overdraft fees. These are people overdrafting more than 10 times per year. That's not financial irresponsibility. That's not poor planning. That's living without a buffer. When you're at zero or close to it, one miscalculation costs you $27 to $35. Your paycheck deposits at 2 a.m., but your rent autopay hits at midnight. Overdraft fee. You forget about that old subscription that auto-renews? Overdraft fee. Your employer delays payroll by 1 day. Multiple overdraft fees because all your bills try to clear at once. With $20,000, none of this happens. You have a cushion. The timing doesn't matter. The forgotten subscription is annoying, but not catastrophic. Your buffer absorbs every timing mismatch, every small mistake, every system delay. But here's where it gets really interesting. Most banks waive monthly account maintenance fees if you maintain a minimum balance, usually $1,500 or $5,000, depending on the account type. People living paycheck to paycheck can't maintain those minimums consistently. Money comes in, money goes right back out. So they pay $12 to $15 per month just to have an account. That's $144 to $180 per year just for the privilege of storing your money at a bank. When you have $20,000, you clear any minimum balance requirement without even thinking about it. No monthly fees, no maintenance charges. Another revenue stream dried up. Now let's talk about credit cards because this is where banks make obscene amounts of money from people without savings. The average American with credit card debt pays over $1,700 per year in interest. Not $1,700 total, $1,700 just in interest charges. That's money paid to the bank for absolutely nothing. No product, no service, just the cost of having borrowed money last month that you couldn't pay back this month. Here's how this trap works. You're living below $20,000 in savings. An emergency hits. Car repair for $800, medical bill for $1,200, refrigerator dies and you need $600 for a new one. You don't have the cash, so you put it on a credit card. You plan to pay it off, but next month brings its own expenses. You can only afford the minimum payment, maybe $35 on a $2,000 balance. At 22% APR, which is about average right now, you're paying roughly $37 in interest that first month alone. Your $35 payment doesn't even cover the interest charges. Your balance actually goes up. This is the designed trap. You can't pay it off because the interest keeps compounding faster than your minimum payments reduce the principal. But when you have $20,000 in savings, you never carry a balance. Emergency hits, you pay cash. You use the credit card for the rewards points, sure, but you pay the full statement every single month. Zero interest, ever. The credit card industry literally calls people like this deadbeats. That's the actual industry term, because you use their product without being profitable. They want you in debt, not debt-free with a fat savings account. But here's what's even more powerful than avoiding fees and interest. It's the psychology shift that happens when you cross $20,000. Below that number, you operate from scarcity brain. Every financial decision is about survival. Can I afford this? What if something goes wrong? What if I lose my job? What if the car breaks down? Scarcity brain is exhausting. It's constantly running calculations. It's always worried. It doesn't let you think long-term because you're too busy putting out fires. I saw this exact pattern in the data. Among Americans living paycheck to paycheck, 78% experienced at least one bill increase in 2024. The top increases were electricity at 56%, insurance at 52%, and gas at 51%. These aren't luxury items. These are necessities. And when you're operating from scarcity, even a $30 increase in your electric bill creates stress. You have to find that $30 somewhere. Maybe you skip a meal. Maybe you don't fill up the gas tank all the way. Maybe you decide the medical appointment can wait. Above $20,000, you start operating from abundance brain. Not billionaire abundance, just basic breathing room abundance. You can take the slightly lower paying job that has better growth potential. You can walk away from a toxic workplace because you have months of runway. You can negotiate harder because you don't need this specific deal right now. Every opportunity changes when you have options. Here's a concrete example. Let's say your boss is treating you terribly. You know you should leave. Everyone tells you to leave. But you're living paycheck to paycheck with $400 in savings. You're trapped. You can't afford even one missed paycheck. Your boss knows this. They can treat you however they want because your desperation is visible. You have no leverage. With $20,000 in savings, you can quit today if you need to. You have 3 to 4 months to find something better. Your boss's power over you just evaporated. Same job, same terrible boss, completely different dynamic because you have a buffer. This applies to everything: car buying, apartment hunting, salary negotiations, business opportunities. When you're broke, everyone has leverage over you. When you have $20,000, you have leverage over them. Now, here's where this gets really interesting. The benefits of $20,000 don't just add up, they compound. When you're not paying $150 per year in account fees, not paying $1,700 per year in credit card interest, not paying $100 in overdraft fees every few months, that's real money. Call it $2,000 per year in total fee and interest savings. That's $2,000 you can put toward building that $20,000 faster. Or once you're there, $2,000 you can invest, save for a house, or use for something that actually improves your life. But the compounding goes deeper than just fees avoided. When you have $20,000, you can take advantage of opportunities that people living paycheck to paycheck can't touch. A friend starts a business and needs $5,000 from early investors, you can do that. A house in your neighborhood goes on sale for below market value but needs $10,000 in repairs, you can jump on it. A certification program costs $3,000 but would increase your salary by $15,000 per year, you can invest in yourself. People without savings can't access these opportunities, not because they're not smart enough or don't see them, they just don't have the capital available when the opportunity appears. Opportunities have timing. They don't wait for your next paycheck or your next tax refund. They appear and disappear. Here's what really bothers me about this whole setup. The banking system is explicitly designed to keep you below this threshold. Think about how hard it is to actually save $20,000. If you can put away $400 per month, which is genuinely difficult for most people, it takes 50 months. That's over 4 years of consistent saving. No emergencies that drain the account, no job losses, no major unexpected expenses. Just perfect execution for 4 years straight. Meanwhile, banks are actively working against you. They process transactions in the order that maximizes overdraft fees, not chronological order. They charge you fees for having too little in your account. They offer you credit cards with limits just high enough to get you into serious debt, but not high enough to actually improve your life. They send you offers for personal loans when you're struggling, knowing the interest rate will trap you. The entire system profits from your financial stress. Every fee, every interest charge, every desperate decision you make because you don't have savings is money in their pocket. They need you to stay below $20,000. Not all of you, obviously, but enough of you to keep that $12 billion per year in overdraft revenue, enough of you to keep credit card interest payments above $120 billion per year, enough of you to make the business model work. But here's what nobody talks about. There's a specific moment in the financial system's relationship with you where everything flips. When you have $2,000 in savings, you're a highly profitable customer. Overdraft fees, occasional credit card interest, account fees, all of it. When you have $8,000, you're still profitable, but less so. Maybe you avoid overdrafts, but you're still using credit for emergencies. The bank makes money on your credit card balance. At $20,000, you become almost entirely unprofitable. No overdrafts ever, no account fees, credit card paid in full every month, no personal loans, no paycheck advances, no desperation products. You're just storing money with them and using their payment network. That's it. They make essentially nothing from you except whatever small amount they can generate from lending out your deposits. This is why some banks have started eliminating free checking accounts for people below certain balance thresholds. This is why overdraft protection programs exist that charge you $12.50 to transfer money from your own savings account to cover an overdraft, instead of charging you $35. They're trying to extract something from everyone, even people with savings, but it's getting harder. The data backs this up. Banks that eliminated overdraft fees entirely, like Capital One and Citibank, saw their overdraft revenue drop by nearly 100% between 2019 and 2024. That's billions in lost revenue per bank. They had to make it up somewhere. Where? Higher interest rates on loans for people who still needed to borrow. Higher account fees for people who couldn't maintain minimum balances. The profitable customers are subsidizing the unprofitable ones. So let's project this forward. What does your life look like in 5 years if you never cross this threshold? You're still living paycheck to paycheck, you're still doing mental math at the grocery store, you're still stressed about unexpected expenses. You're 44 instead of 39, or 59 instead of 54, and you're in the exact same financial position you are right now. The bills are higher because of inflation, your income might be a bit higher too, but you inflated your lifestyle right along with it. Net position? Zero. Meanwhile, the bank has extracted maybe $10,000 from you over those 5 years in fees, interest, and desperation loans. Money that could have been building your savings, money that could have been invested, money that could have changed your trajectory. Gone, transferred to their profit column. Now imagine the other path. You hit $20,000 in 2 years through aggressive saving, side income, or a combination. Over the next 3 years, you're not paying any of those fees. You're not carrying credit card debt. You're not stressed about every unexpected expense. That's $2,000 per year staying in your pocket. Over 3 years, that's $6,000 just from avoided fees and interest. But more importantly, you're making different decisions. You negotiate harder for that raise because you have a buffer. You get $5,000 more per year. You move to a better opportunity because you could afford a month between jobs, another $8,000 per year. You invest in that certification that increases your value, another $10,000 per year long term. In 5 years, the person who crossed $20,000 isn't just ahead by the $20,000 they saved, they're ahead by the fees they avoided, the better decisions they made, the opportunities they could take, and the stress they didn't carry. The gap isn't $20,000. The gap is probably closer to $60,000 to $80,000 in total financial position, plus the psychological benefit of not living in constant financial stress. Most people never make this jump because they think it's impossible. They see $20,000 and think that's a fantasy number, something rich people talk about. But rich people aren't trying to get to $20,000. They're already way past it. The $20,000 threshold is specifically for regular people, people making $40,000 to $80,000 per year, people who work normal jobs and have normal expenses. This is the number that changes your relationship with money and with the financial system. The banks know this. That's why they make it so hard. That's why the system is designed to keep you below this line. Every fee structure, every minimum balance requirement, every interest rate is calibrated to extract maximum value from people who don't have savings while rewarding people who do. It's not an accident. It's the business model. Here's the truth. $20,000 isn't the finish line. It's not retirement money. It's not generational wealth. It's not even enough to call yourself rich. But it is the first real milestone where the game fundamentally changes. Below $20,000, you're playing defense. You're reacting to emergencies. You're making decisions from stress and scarcity. You're profitable for your bank. Above $20,000, you can finally play offense. You can build wealth. You can take calculated risks. You can make decisions from strength instead of fear. Your bank built their entire business model on people staying below this line. Every fee, every interest charge, every desperation product exists because people don't have savings. Every dollar you add to that account is a dollar they can't extract from you. You get to decide where you want to be 5 years from now. Same position, same stress, same bank profits extracted from your account, or $20,000 in savings, options multiplying, stress dropping, making decisions from a position of strength. The choice is yours. The path is clear. The number is specific. $20,000. Get there and everything changes. If this breakdown showed you why that first $20,000 matters so much, hit that subscribe button. I drop videos every week breaking down the money systems that actually impact your life. Comment below and tell me where you are on this journey. Let's track this progress together. Now go stack that cash. I'll see you in the next one.